Hi, good morning, everyone. So welcome to our Monday morning webinar. So today we'll be having a FLT FCOT merger update as well as a Singapore Banking Monthly update, and followed by our technical analysis for the sector. So first off, we'll start off with Singapore Banking Monthly. So for the month of October, our Singapore's loans growth is still rather sluggish at 2.6%. So this is the light blue line that you see in the chart here. So overall, business loan is still the one lifting up the Singapore loans growth. So business loans is 5% as compared to our overall loans growth of 2.6%. And whereas consumer loans is still contracting at negative 1% year on year. And for consumer loans, as you can see from the red line here, it has been contracting for the past 7 months. And this is more or less due to the contraction in the mortgage segment. So housing loans growth contracted 1.4% year on year. However, moving forward for the full year FY19 loans growth target for the banks, it should hit around mid-single digit on average. Whereas moving forward to FY20, given the bank's guidance, slowing macroeconomic environment and various headwinds, the banks have been guiding around low to mid-single digit for FY20. Moving on to deposits. So from the chart here, you can see that fixed deposits momentum is still very strong, as seen from the red line here. And CASA, which is the light blue line, our current and savings accounts have recovered from contraction in the first half of 2019. So despite the recent 3 Fed rate cuts in the second half of 2019, plus downward adjustments of fixed deposit rates across the banks in Singapore, fixed Ds are still growing rather strongly at around 20% year on year in the latest month of October. So you can see that part of the reason why is actually due to saturation of appetite for Singapore savings bonds. So for SSBs, the interest rate that investors right now could get for a 12 months tenure is around 1.5 to 1.6%. And if you compare that to the banks like DBS, UOB, OCBC, Maybank, CIMB, Hong Leong, they are offering around 1.5 to 1.8%. So as compared to SSBs, investors would still opt for fixed Ds, which could also explain why fixed Ds are still growing quite strongly this year. And for interest rate wise, 3-month SIBOR fell 4 bips to 1.769. 3-month SOR rose 2 bips to 1.537, which is rather flat. So the US Federal Reserve's easing monetary policy will definitely limit the upside for net interest margin expansions in the next year. And we are already seeing contraction across all banks in the third quarter results on a quarterly basis. So lower funding costs should offset some of the impact of lower interest rate on the bank's net interest margins, because the banks still have the flexibility of controlling the cost of funds to still maintain a certain spread on their net interest margins. And as for SGX updates, as you can see from the chart, the table here, for the month of November and October, the year-on-year growth for the 4 most popular volume derivative contracts by volume has contracted for SGX. So based on the October and November figures, you can more or less guess that the second quarter 2020 results for derivatives may not be as good as the first quarter. So so for the structural story for SGX derivatives is still intact because besides benefiting from the occasional volatility from the trade war or Hong Kong protests or different reasons, geopolitical reasons, there is still underlying growth in the derivative market. So as businesses expand and derivatives volumes will be sustained by increasing connectedness around the world as well as globalization of markets. So businesses need to hedge more as they expand across the world. So for SGX derivative volume from non-equity products such as the FX and commodities, they grew from virtually 0 5 years ago to 15% of total volumes last year. So based on this and continuous diversification efforts from SGX, the derivatives volume for SGX will continue to grow as well. So for October's DDAV, it fell 22%, and November's derivative volume fell 14.7%. So to have more of a sense on how China A50, which is the most popular contract in the derivatives business for SGX, affects SGX as a whole, from this chart at the bottom, you can see that China A50 made up 37% of total volumes in first quarter 20. So if MSCI Hong Kong Exchange were to announce the launch of the China A50 index on their part, that could affect SGX share price as well. Based on the news alone, it could affect SGX share price. So moving on to Hong Kong's loans, it grew at a respectable pace of 7% year-on-year despite the ongoing protest and elevated interest rates. So 3-month HIBOR rose 19 bips to 2.355%. So our overall investment action for the Singapore banking sector is still at overweight. So interest rate cuts and slowdown in the global environment are the two main headwinds that we will expect in FY20. However, the tailwinds are the growth in fee income and other non-interest income. So wealth management has been a very strong focus for the banks in the past few quarters, and it's growing very strongly at 20% across the banks on a quarterly basis. And the banks also have a dividend yield support of 5% for that sector, and this limits the downside for the share price. So downside to net interest margin is also because expected to be slightly offset by better deposits mix as they release excess fixed Ds and also adjust the funding cost to maintain a certain spread on the net interest margins. So with lower interest rate, there's also a potential rise in volumes as the source of funding becomes cheaper and volumes rise. So for the sector, our top pick is UOB due to a lower exposure to Greater China and Hong Kong. So you can see from the lower chart on the right-hand side that UOB is only 16% exposed to Hong Kong and Greater China as opposed to the total loans of UOB. So DBS is 30%, OCBC is 25%. And also UOB has low net interest margin sensitivity to falling interest rates, and its wealth management franchise is much more defensive than DBS and OCBC because UOB targets the mass affluent, which generates a more recurring and stable base of fee income from wealth management. Whereas DBS and OCBC targets the high net worth and ultra high net worth individuals. So that's it for me. I'll pass on to Jie Hui for Frasers Logistics and Industrial Trust.
Hi, so next we'll be going through the recent announcement. We'll be going through the recent merger of Frasers Logistics and Frasers Commercial, FLT and FCOT for short. So just a disclaimer, we do not cover both Frasers Logistics and Frasers Commercial. So this is just a brief note. The proposed merger of FLT and FCOT is to create a flagship portfolio of commercial and industrial assets. And this is done on two fronts. Firstly, FLT is to acquire all FCOT units held by unit holders of FCOT. So FLT will be acquiring FCOT. And then secondly, subject to the completion of the merger, FLT will subsequently acquire the remaining 50% interest in Farnborough Business Park through FCOT to hold 100% interest. Previously, FCOT was actually holding 50%. So with this acquisition, they'll be holding 100%. The scheme consideration is as follows. So FLT will be paying $1.68 per FCOT unit with an implied gross exchange ratio of 1.355 times. This is actually done on a price to NAV ratio of 1.031 times, and is done also on a 3.5% premium to its 1-month VWAP and 8.2% to FCOT's 12-month VWAP. Yeah, maybe just another point to note is that 1.03 is also the market average for commercial REITs in terms of price to NAV. So in a sense, FLT is actually paying a fair value for this merger. This consideration will be done in the form of cash and also in terms of new units issued. For the second part of the merger and acquisition is the property acquisition. So for the acquisition of FPP, the agreed property value is actually at 90.5 million euros, which is at a 0.9% discount to its property appraised value of 91.3 million. This acquisition is going to be 100% debt funded with a high NPI yield of 6%, high occupancy of 99.1%, long WALE of 6.8 years, and also 18,000 square meters of development potential yet to be unlocked. This is also an award-winning business park. So here are some key takeaways for this merger. First of all, there will be DPU and NAV accretion for this merger, but there will be more DPU accretion post-acquisition of FPP. Okay, in FLT's perspective, there'll be accretion of 0.6% post proposed merger. But you can see from the left hand side as well, post proposed merger and post proposed asset acquisition, the accretion will be actually 2.2%. Similarly for FCOT as well, on the right hand side, you can see that post proposed merger, the accretion is actually 2.5%, but post asset acquisition, the accretion will be up by 4.2%. For NAV, FLT will actually see a accretion of 9.5% post proposed merger and also post proposed asset acquisition, because this acquisition is going to be fully funded by debt. Secondly, we see as a scale play. So you can see from here, the enlarged entity is basically a combined version of FCOT and FLT with now 98 properties across 5 countries in mainly 2 different asset classes, meaning office and industrial. And also another thing to note is that the gearing actually increased post-merger because of the new debt facilities that they are going to take on in order to pay off some of the acquisition in cash. So these are some of the benefits of the merger. First of all, there is a potential for this enlarged REIT to be amongst the top 10 largest S-REITs in terms of market capitalization. Yeah. So lifted by enhanced free float and trading liquidity as well, there's a potential for positive re-rating and also a higher weightage in the FTSE NARI index with the addition of FCOT's float. Other benefits also include a wider investor base and also potential broader analyst coverage. Next, we can also see synergies within its ecosystem as well, as they'll be able to provide end-to-end business solutions across the economic value chain. Okay, they will definitely see diversification benefits as well in terms of geography and also by asset. So I think if you look at FLT's point of view, okay, for both FCOT and FLT, previously they were pretty concentrated in certain geographies. Like for example, in Frasers Commercial, they are concentrated in Singapore and Australia. And for Frasers Logistics, they are more concentrated on Australia and Germany. Being an enlarged REIT, they will actually see some synergies in Australia and also gain exposure to new markets in Germany as well as in Netherlands. Okay, so similarly by asset as well. So previously FLT has 100% in industrial and logistics properties. But post acquisition, post merger with FCOT, you can see that now this portfolio actually comprised of office and like suburban offices properties, and it significantly reduces the exposure in China Square Central, which is FCOT's largest asset, from 29% to 11%, and 100% of FLT's properties, 100% exposure to logistics and industrial properties for FCOT, becoming to 58.4% worth of exposure in logistics and industrial properties for the entire enlarged REIT. Similarly, we will see diversification in the form of tenancy as well. So you can see like with the increased number of tenants, we can actually see a more balanced form of tenancy ratio between single tenancy and multi-tenancy. The enlarged REIT will have a WALE of 5.8 years and also a high committed occupancy rate of 99.5%. For the last, okay, bear with me, 2 more slides left. So like this enlarged capital base for this enlarged REIT will actually provide more flexibility and ability for this FLT to actually drive long-term growth. They will actually have a larger debt headroom. As you can see from here, post-merger, they will actually have about 1 billion in terms of that headroom. And post-merger and asset acquisition, they will actually have about 870 million left for AIs and also development projects of a larger scale. Lastly, the REIT will actually have a bigger ROFR pipeline in excess of 5 billion, and also they'll be able to leverage on the sponsors' integrated development and asset management capabilities better. Now I'll pass my time over to Wei Ren, who will tell you more about technical analysis.
Thank you, Jie Hui. So today's sharing will be the update of the last week sharing on Straits Times Index, and then followed by the America's Dow Jones Industrial Average. So let's move on. For Straits Times Index, price has a slight rebound during the midweek of December last week. So sentiments still remain the same as last week sharing on the 2nd of December, whereby the range will be between 2009 and 3006. And we will still see some bullish action despite that, despite of a price decline during the start of last week. So symmetrical is still valid. It has not broken down, or nor it has broken to the immediate supply area, but we believe that it will soon, given a couple to maybe next year start, because as December the volume is not there. So as I shared, price has completed the A wave for the running flat. Once price actually break out of the panel or the symmetrical triangle of the fifth wave as labeled, we can see that the B wave will be located near the supply area between $3,005 to $3,570 level. So move on. Also before that, why is still bullish? Because on weekly chart it closed. Actually price actually reject the 200 SMA, and it's actually a pin bar and a long lead doji. Okay, immediate supply area highlighted in chart shows us immediate bearish reversal zone that we believe that price will have a false breakout to form wave 4, and then after subsequent true wave down to form wave 5 on the symmetrical triangle. So move on to the daily chart. Daily chart still shows a potential upside because of bullish back flag formation. Excuse me. Last week we shared that the price actually will have a bullish reversal at 50%, but however we were wrong. So price actually reversed down, has a slight potential back to 3151. And then it reversed at 61.8. And then why I'm so convicted is because the 61.8 is actually confluence with the bullish flag second touch. So, and last, the stochastic oscillator shows that current sentiment is oversold, and there's oversold crosses already. So we believe that price might edge higher. Okay, so let's move on to Dow Jones. Dow Jones 30,000 may be possible, as we shared during last week. Once it breaks 28,000, especially after price has already resumed back above 28,000 as of last Friday. So let's move on. So bullish trend is continuing despite a bearish correction last Monday due to the trade war issue. So during our sharing on 2nd September, there's a potential reversal downwards, and we believe that the support zone highlighted at near 38.2% of Fibonacci retracement is actually act as a support zone, and it clear enough, it actually has a slight bearish correction down, long lead doji above it, above 50 SMA, and then it reverses up. However, please do cautious that there's a potential head and shoulder formation going on. Although it break like what I mentioned, it break 28,000 psychological level, but it's only 38 points up only. So in order for the bullish trend to continue, first the price must break the major resistance level zone between 28,038 to 28,200. In other words, 2 candle above this resistance zone level. So I would like to caution everybody to, especially those who are in Dow and non-American market, so to actually be cautious about it. So with that, I end on my presentation. So is there any questions? Also, just an update. This webinar will be the last one for 2019. So towards the end of the year, we will not be having any webinar from next week onwards until the first week of January, on the 6th of January or 2020. Thank you. Hi, actually the Dow Jones and S&P 500 actually mirror each other. With S&P 500 is actually for these 2 years, it usually is the Dow Jones lead the market, but in the recent years, these past 2 years, actually Dow Jones actually is lagging behind S&P. So I checked the chart of S&P 500. There is also a similar pattern like the Dow. Let me go back to the. Okay, so for the Dow is actually perfect head and shoulder formation, while the S&P there's an uneven right shoulder. Means the right shoulder is slightly above. So to determine whether there's a S&P 500 there's a potential head and shoulder, we'll see how the price react tonight when the market open at 10:30 p.m. Singapore time. So I hope that answers your question about the S&P 500. Thank you.
Yeah, thank you for your questions. We're still getting back to you on one of the questions. We got a question. ST has lagged almost all US indices for the second half of 2019. Are you expecting a catch up in early 2020? STI has lagged the US for many years. In terms of catch up, probably first half, second half probably there is some chance. Okay, anyway, just to give you the some sequencing of events. Okay, as you know, STI 40% come from the banks, so I think the first half of next year could be a bit tricky for the banks. I think they've been guiding weaker margins and slower loans growth. So until economic expectations are tilted upwards, I think there could be some underperformance by the banks. So that's number one. But on the flip side, in the US, do note that there's probably some political situations to monitor. I think the first one is, of course, Super Tuesday, which is the 3rd of March. I think that is when we will see who's going to be the Democrat primary candidate. So although it's a tail risk, but if Elizabeth Warren takes the lead in the nomination, then you will definitely see the US underperforming as the US market will probably get down on the 3rd of March. But anyway, for us scenario, I think most likely would be we could underperform in the first half, but second half we could play catch up as the global economy starts to recover much better. And as you know, when global growth tends to improve, the US tends to lag because the US is at least viewed by the market as more domestic centric. So my bet is probably first half underperform STI, but second half we could play catch up. And also the second thing is the second half, the US, as you know, the US economy, the upturn has been quite elongated, and then you could see some fall off in the fiscal stimulus 2 years ago. So we think second half could be a weaker economic environment for the US. Yeah, thanks. Yeah, sorry for the long answer to a short question.
Hi, so we have one question on what to do with the odd lots. If let's say you hold FCOT shares and post merger, what should you do with the odd lots? Depending on your stand, you can either acquire more to make it a full lot, or else you can sell away your odd lots. For FCOT and Ascendus Hospitality Trust, the merger that was just concluded, the REIT manager actually did enter into some agreements with respective brokers, such as ourselves, Phillip, as well as UOB, where they help to secure preferential rates for the trading of odd lots. So I think that is still quite early on in the deal, so I don't think there's any arrangements yet.
Hi, so we have a question on where are the banks Singapore banks finance industry in digital banking, fintech and blockchain, and is there anything concrete coming through in 2020? So right now for the banks, the main thing that's happening is a virtual banking license. So for us, what we expect is that in the first few years after MAS has issued the virtual banking license, there should not be any substantial impact on the banks yet, because what they could do is still quite limited, and their proposal is subject to whether they are profitable as well. So usually when banks they start the businesses in the first few years, there's a lot of gestation and a very steep learning curve for these new virtual banking license holders. So Whereas if it's a threat, there's not much threat coming, but yes, it's rather concrete that we're going to have a virtual banking competition coming soon. So as for other fintech developments, as you know, all three local banks are already heavy into digitalization, especially DBS. It's being rebranded as DigiBank of Singapore. So for the banks, they are very well into the digital space, and they are constantly putting in investments to increase the technological and keeping updated to compete with global banks as well. So that it's one of the niche for Singapore banks as well. As for anything new that's upcoming for the Singapore banks, nothing new in the digital banking space. They're just continuously improving on the existing investments.
Hi, so we have one more question about someone's concerned about the heavy concentration in Australia for FLT and the enlarged FLT FCOT. So actually, if you look at our slide that is currently showing, FLT actually has a pre-merger. FLT's exposure to Australia is about 58.3%. So post-merger, the portion that is the portion of AUM in Australia will actually fall slightly by about 10 percentage points to 48.4%. That being said, it means that there's less concentration of revenue derived from Australia. Additionally, FCOT also has FX hedging policy in place where they hedge close to 100% of their distributable income on a 6 months rolling hedge. So I mean, if you look at their past results, yes, FLT has actually recorded fall in revenue due to the FX, but this added diversification will actually help the enlarged REIT. We have another question about whether or not investors that are currently holding on to FCOT, Frasers Commercial Trust, should sell the shares in FCOT to buy FLT instead of waiting for the completion next year. Because the exchange ratio, which is 1.335, is actually already set. So the market will have priced in the price for FCOT at about 1.68, which is the agreed share price, as you can see on the slide that is currently showing. So the only difference is for FCOT unit holders, this 1.68 price has already been locked in, and it will generally trade in line with this price. We have a question about the preferential rate offered by Phillip Securities for the trading of odd lots. So our odd lot minimum charge is subject to a minimum charge of about $10. So for the previous deal, what Ascender's Hospitality Trust negotiated was for them to absorb the charge. But this is a past deal that is not applicable currently. So we have to wait for further details on how the manager of FLT would like to help their shareholders with respect to this odd lot. Okay, thank you for joining us this morning. So if there are no more questions, we'll be ending our webinar here. Thank you for tuning in.